Morning and welcome to AS Level Accounting Revision. We're going to be looking at the past papers from March and June 2016, papers 1-2 for both of those sets of papers. Please make sure that you do have them with you so that you can see very clearly what I'm talking about, although I will have the questions up on my board as well. Let's start with question 1 of June 2016. This question says, what might stop financial statements showing a true and fair view? A true and fair view is referring to the relevance of financial statements that they must be a fair presentation of the actual financial position of the business. If they are not, people can't trust those statements. So it's very important that they need to be as objectively prepared as possible. So let's have a look at the options and see which we like as objective. A. Changes in depreciation methods from year to year. If you decide to change how you calculate your depreciation from one year to the next, in other words, maybe a change from calculating the percentage depreciation on cost to looking at the book value and working out a percentage of that, or alternatively using the book value as it is and working out every year what the actual value should be and depreciating accordingly, each of those different methods vary from each other. And if you change the method from one year to the next, it means you're not able to compare the statements of one year to another effectively because they are different. So this is a little bit more subjective. So that is certainly an option as an answer for this question. But before we make up our minds, let's go and read the rest just to check that there's not something more relevant. B, changes in dividend policy. Dividend policy refers to how much you decide to pay out to the owners compared to the profits that have been earned. Now, although a change in this policy from year to year will obviously have a different effect, the actual amount that is paid is paid. It's not subjective at all. So B is definitely objective, and therefore it would still be true and fair. Therefore, we don't like option B as an answer. C, the creation of a general reserve. A general reserve means that you are taking some of your money and you're setting it aside so that you can't distribute it to owners, but rather keep it safe for further expansion of the company, for example. Again, this is an objective thing that you are going to do. It's not a decision that is going to be subjective. If you've put money into the reserve, it is still a true and fair view. So therefore, C can also not be an answer. D, inclusion of purchased goodwill in a statement of financial position. Goodwill is an intangible asset. In other words, you can't actually feel and touch it, but it is still something that belongs to you. Now, you've got to be quite careful with goodwill because you don't want to include it if it's too subjective, because you can't just decide that your company is worth a certain amount. However, look at the phrasing here. It refers to the inclusion of purchased goodwill. In other words, you have paid a certain amount of money for that. And since it is what is referred to as an arm's length transaction, in other words, there is another party involved, it is also objective and therefore does not change the true and fair view. So therefore, D is not an answer and you can choose A. The second question that we are going to look at is question 5. From June 2016, paper 1-2. Which statement about the sales ledger control account is correct? Remember that the sales ledger control account is the account that shows all the different sales that were made to customers. In other words, it's kind of like a summary of the individual customer accounts. It helps you to control them, hence the name control account, so that you can check that you haven't made mistakes, etc. A, it is to verify the total of the customer's account balances in the sales ledger. This is certainly an option. So we can think about it, but let's go and have a look at all the others as well. Just to clarify, Verify the total of the customer's account balances. This over here is what is important, is that you're looking at your customers. And that's exactly what the sales ledger control does, is it's showing your customer accounts as a summary. B, it is used to calculate the gross profit on sales. This is not an option because to calculate gross profit, you would need to have sales minus cost of sales. And for B, there is no cost of sales that you would need to calculate your gross profit. So therefore, B is not an option. C, it is used to calculate the total sales for the year. This one looks a little bit more believable, but if you think about it carefully, total sales is where we are a little concerned. Total means credit sales and cash. And since there are no cash sales in my sales ledger control account, because it's only my customers' account balances, in other words, credit sales, C is also not an option. D, it is used to reconcile the cash received from customers with the bank statement. Well, although we are going to show the cash received from customers in that account, we're not going to show the bank statement there. The bank statement is not going to appear anywhere in this account. And to do a comparison with the bank statement, you would actually want to use the bank account rather than just your credit customer accounts. When you're comparing to the bank statement, you're actually going to do a bank reconciliation. So therefore, the only option left to you is in fact A. We're now going to look at question 6 from the same exam paper. In which book of prime entry is the contra between sales ledger control account and the purchase ledger control account recorded? Let's first understand what the question is asking. Remember that your sales ledger control account is the summary of all your customer accounts who have bought on credit. And your purchase ledger control is all the purchases that you have made from your creditors or your suppliers. This is asking about if you're making a transfer between these two accounts. An example of why you might do this is, for example, if you buy something from a supplier, but you also sell to them as a customer. It doesn't make sense to have two separate accounts for them. So you might want to combine their two accounts into one account by transferring, for example, their customer balance to the supplier balance in the purchases ledger control instead. What is happening here is that the two accounts involved are going to be your customers and your suppliers, or your sales control and your purchases control. Let's have a look at what the options are in the different journals. Remember, prime entry means original entry, in other words, the journal or the summary of all of those transactions. We are looking for something that would be able to show the purchases control and the sales control. A is a cash book. A cash book is a summary of wherever bank is involved. Is bank involved over here? No. So we can't use A as an option because no cash has changed hands, neither in nor out. B, the general journal. Well, that is certainly an option because the general journal is what I like to call the orphanage. It's where all the transactions go that don't have a nice home in your cash book, your purchases journal, sales journal, etc. So let's keep that open as an option for now. C, the purchases journal. This is a summary of all the purchases that are made from suppliers so that your purchases account can be debited. In this case, it's not affecting purchases. Although your purchases control is affected, that's only because of the supplier account. So C is also not an option. We haven't bought anything extra here. D, The sales journal. Well, in exactly the same way as we didn't like C, we also don't like D. The sales journal is a summary of all the sales to customers, and in this case, we are not making a sale to a customer, we are simply transferring a customer's account. So D is not an option. Therefore, that leaves us with B, and that's the one that we are going to choose. The next question is taken from June 2016, paper 1-2, question 7. A business omitted discounts allowed of $700 from its trial balance. During the year, a machine had been sold for cash of $500, but the only accounting entry made was a debit in the bank account. What is the balance on the suspense account before these errors are corrected? Now, instead of going and having a look at each answer first, let's work out what we want the answer to be, and then we will go and see if it is there. Wherever you have to do calculations or workings, this is the method that I would suggest. So you can see I've drawn up some rough T accounts so that we can try and recreate what should have happened instead. Basically, we can see there are two things over here. If discounts allowed of 700 Rand were omitted, let me just move it back so you can see it more clearly, that means that what would have happened is there should have been 700 Rand discounts, but they are not. Notice that what I do in my rough calculations is I just draw a line, and below the line I show what it should have been. In this case, there were supposed to be $700 of discounts, but there weren't. So therefore, your correction would have been a debit of 700 in discount allowed. That means that in your suspense account, as a correction, you would have had to do a credit of 700 Rand discount. That's how you would have fixed the first part of this problem. Let's have a look now at the second part of the problem. A machine had been sold for cash of $500, but the only accounting entry made was a debit in the bank account. So that means that your bank account is correct, but there was no entry in asset disposal. In other words, your profit or loss on sale of asset would have been incorrectly calculated if it was calculated at all. So what should have happened over here is that you should have said bank $500. However, since it was an error, that entry did not go in. So instead of taking it with bank, it would have been with the suspense account. So we would have had suspense 500, and if that's on the credit side in asset disposal, it means that in my suspense account, I would have had to have an entry for asset disposal of 500 on the debit side. What we can do now is have a look and see. At the end, you would expect to have your suspense account closed off with nothing left over. So if we work backwards, we can then see that the balance in the suspense account at the beginning must have been 200 on the debit side. We now go and have a look at the options given above, and you can see that A is your option of 200 on the debit side. So A is going to be your answer of choice. We're now going to look at questions from March 2016, paper 1-2. This is question 1 from that paper. A business has a good reputation. The owner wishes to include goodwill in the financial statements. An accountant advises against it. Do you remember in one of the previous questions we spoke briefly about goodwill? It is an intangible asset, and although it does have value, in this case, what is happening is that the owner is wanting to value it himself. In other words, it would be a subjective valuation. As such, it could not necessarily be considered a true and fair view. In other words, it's not proper fair presentation of the actual situation because it's too subjective. If he were to bring a different partner into the business and the partner were to pay part of the value of goodwill, then a calculation could be made to value it. But in this case, it is not objective enough. This is why the accountant does not think this is a good idea. Let's have a look at the concepts that that you need to choose from. The business entity concept is talking about the fact that you would keep your accounting records of the business completely separate from those of the owner, because what the owner does privately is not going to impact on the success or failure of the business. The difference is simply where the owner is going to take too much money out of the business, then yes, it would have an impact, but that's why we will show that as drawings. That would not be a business expense. That's got nothing to do with goodwill. Going concern refers to the fact that you would expect that the business is carrying on its normal business operations for the foreseeable future. In other words, your valuation of assets, both current and non-current, is realistic and reasonable. You don't expect to have to suddenly have a closing down sale and sell everything at half price. Matching refers to the fact that you would like to keep your incomes and expenses that relate to each other in the same period. In other words, you match your incomes and expenses for a particular period. The IFRS concept here would be accrual. In other words, you don't only look at cash transactions, but you also consider whether something has been prepaid or paid in advance, compared to still owing, in other words, accrued. The last option is prudence. Prudence is saying that you like to be a little bit more conservative rather than too optimistic. Yes, optimism is a wonderful characteristic to have, but not for an accountant. As an accountant, we want to be a little bit more objective and a little bit more conservative if we need to make choices. So prudence is actually what the accountant is concerned about over here. He doesn't want to value the business much better than what it might realistically be. So that will be our option D. However, I just want to make a little note that when you are looking at the concept of prudence, you need to consider the IFRS concept of fair presentation. If fair presentation is more relevant than prudence in the situation, then you would need to go with fair presentation instead. It actually would overrule your prudence. But failing that, we can always be a little bit more conservative. Let's now look at question 5. A sales ledger control account was prepared. An irrecoverable debt of $40 was omitted or left out, and a discount allowed of $68 was entered as $86. What was the total effect of these errors on the closing balance of the sales ledger control account? As before, the best way to work this out is to work backwards through T accounts to see what should have happened and then figure out what actually did happen. Firstly, let's understand that your sales control account, which is the account that they're asking about, they want to see the total effect on that sales control account. Understand what that is. Remember that that is the summary of all your different customer accounts in one place. In other words, you've got individual accounts for customers A, B, and C, but everything that happens with all of them will be summarized over here. This helps you to be able to control and check for errors, etc. This account is an asset account because your customers owe you money. So keep in mind that it is going to be shown as an asset, and your debits is where it's going to increase, and you will decrease it with credits. Remember from your accounting equation, that's how you learned that on the debit side of an asset account is where it increases, and you will minus it on the credit side. If you have a look now, let's consider the first transaction, which is the bad debts of $40. If these were omitted completely, the way that you would have had to correct it would mean that you would have to put 40 Rand on the credit side of sales control because you would have had 40 Rand in bad debts. The second part that we need to be concerned about is the discount allowed of 68 was entered as $86. Let me move this back a little bit so that you can see more clearly, especially because the discount account is now a little bit trickier. What I would suggest you do over here is show what your discount allowed should have been at the end. It says it should have been a discount of 68. So you show 68 on the debit side below the line because that's what you would want to have in the discount allowed account. However, what did actually happen was that an amount of 86 was entered. Therefore, to correct this error, it would mean that amount of 18 would have had to be adjusted on the credit side of discount, and in other words, on the debit side of your sales control to fix that error. If you have a look at your sales control account now, hopefully you can see that if you work backwards, you would be able to determine that there is an amount of 22 over here that is the difference that would have been the error initially. And that to correct that debit of 22, you would have adjusted by debiting 18 and crediting 40. So we worked backwards to get a debit of 22. Because we understand that this is an asset's increase on the debit side, that means that this account is overstated by 22, and you would choose A as your answer. Let's look at question 6. The trial balance totals are as follows. Debit $500,150 and credit $500,000. You can hopefully immediately see that you have a debit of $150. That is too much. That means that we're going to look for an error where something was debited and not credited. So, which error could have caused the difference? If you have a look at A cash sale has only been recorded in the sales account. Sales is an income account, and as such, it's going to increase owner's equity and therefore will result in a credit if you haven't done anything else. So therefore, A is not an option. B, a credit purchase has only been recorded in a supplier's account. Suppliers are liabilities, and as such, hopefully you will remember that you are going to increase liabilities on the credit side when you buy from the supplier. Again, that's going to result in an extra credit, so B is not our option. C, a credit sale has not been recorded. If you leave something out, obviously it is wrong and there is an error, but you will not have debit or credit for that transaction, and therefore there's going to be absolutely no effect, and they would be exactly the same. That is not what has happened here. So C is not an option either. That leaves us with D. But before you rush into answering it with D, let's quickly check that we are correct. A credit sale has only been recorded in a customer's account. A customer is an asset. As such, an asset account, hopefully you will remember, will increase on the debit side. So therefore, if you put something only in the customer's account, yes, we will end up with a debit of 150, and therefore D is the correct answer. The last question we are going to look at in this revision session is question 7. A business maintains a provision for doubtful debts of 5% per annum. It has trade receivables balances of $560,000 at the start and $468,000 at the end of the financial year. Which statements are correct? Before I even look at the statements, I would like to draw up some T accounts to see what would actually happen here, and then we can check the statements to see whether they are correct or not. You will see that I have entered my beginning balance and end balances into a rough T account for trade and other receivables. And what I would also like to do is take that 5% and put it over here next to my doubtful debts so that I can then easily work it out from there. Notice that I have abbreviated horrendously for the provision account and the adjustment account. Go ahead and do this in your T accounts when it's rough work for yourself. But whatever you do, don't you dare do this in an exam. They will not mark you correctly if you don't write it out in full. I know it's a lot to write. Just learn to write quickly. So, if we have balances of 560,000 at the beginning and 468,000 at the end, that means that there would have been an overall effect of 92,000 Rand that debtors have paid off during the year to decrease their debt. So that would have been a bank increase of 92,000 Rand. Your provision at the beginning of the year would have been 28,000. In order to calculate that, I simply said 560,000 times 5% to get my 28,000 Rand. At the end of the year, I would calculate in the same way, but this time using the 468,000, and I will see that my provision needs to be 23,400 using 468,000 times 5%. Therefore, my adjustment that I would have had to make would be a decrease in provision because there's less money owed to me. I would need to adjust it by 4,600 Rand. Simply by comparing those two figures, you can see that it's dropping by 4,600, so you'd need to put it on the debit side. If it's on the debit side in the provision account, that means your adjustment would have to be a credit. So what does that mean? Well, your provision adjustment account is an owner's equity account. And remember, owner's equity gets smaller on the debit side and bigger on the credit side as a result of the accounting equation. So that means that I want to increase owner's equity by 4,600. So that means this would need to be an income account, or it would increase my net profit at the end of the day. In my financial statements, I would have a note for trade and other receivables, and inside that note, I would show my 468,000 over here, and from that, I would subtract my 23,400 provision inside the note for trade and other receivables. Now let's go and have a look at the options available to us. Number one, customers' accounts have been credited with 4,600 Rand. If you look over here at your trade receivables, yes, they have been credited, but it's a 92,000 amount, not the 4,600. So therefore, that is not an option. So number one, we're going to cross out. Number two, 4,600 is treated as an income in the income statement. Over here, you can see that we've already worked that out. So yes, we are very happy with the idea that 4,600 is an income. So we do like number two. Number three, 4,600 is deducted from current assets in the statement of financial position. Be careful here. This is a little bit of a tricky one. Yes, we did say we're going to subtract the provision of 23,400 in the note in trade and other receivables. But note, it's the 23,400, not the 4,600. So therefore, number three is also wrong. Be careful. If that amount had said 23,400, we would have liked option 3, but we don't. And therefore, your answer is going to be C. 2 is the only option here. Thank you for your time. I do hope this has helped you to understand everything a little bit better.